I'm Morella Fernandez. Thanks for joining us today on Market Call. Greg Newman on the show, Senior Wealth Advisor and Portfolio Manager of Newman Group at ScotiaMcLeod. He's here to take your questions on North American equities and market protection strategies. Here's how to reach us. Call us toll free, 1-855-326-6266. You can also send us an email, marketcall@bnnbloomberg.ca. Greg, thanks for coming in. Appreciate you making it in today.
Morella, nice to be here.
Let's talk a little bit about uncertainty, because we now know, according to Donald Trump today and at this second, that March 4th is that first deadline he's sticking with. So 25% tariff across the board, 10% on energy. We talk about uncertainty, and now I would say there's a little less uncertainty because he's confirmed that.
Yeah.
Does that help at all to sort of gauge where you need to go, where investors need to go?
That's a really, really good question. We get this all the time. What should we be buying if these tariffs go on? And really, the answer is very little, very little. If these tariffs really go on, and if they go on big, when I say big, I mean like 25% across the board, and if they're lasting, and if this is really their game plan, you want to be owning a lot less stocks, because the textbook or the playbook is going to be recessionary. It's going to be deeply recessionary for Canada if that happens, and it's going to be recessionary for the United States as well. So it's it's not going to be a question of what should be owned. It's going to be owning what should be sold, and you want to really bring down your equity allocation if that really comes to pass. So I think, if people want to know, is this really going to happen? And, I think anything can. We're certainly in uncertain territory. But as your Northern Star, as your anchor, look at Scott Bessent's, the Treasury Secretary's 3-3-3 plan. 3% GDP growth, 3% debt to GDP, which is very deflationary to cut the government like that, and 3 million more barrels. The U.S., if you're looking at the U.S., what is their biggest priority here? It's to grow and to cover their debt at some point, because at some point that's going to be calamitous if they don't get in front of that debt. They are never going to get in front of that debt if that economy doesn't grow. So they're trying to get from 2 to 3%. It's not going to happen with tariffs. So I submit that a lot of this is the gamemanship of Donald Trump. Watch me be wrong. You don't want to be completely, misallocated if we end up being wrong about this. But I do think the end game of the Trump administration is really three things from Canada. I think it's fentanyl, it's the border, it is the Arctic, and it is paying our fair share of NATO. So, and then a lot of it is antics as well, maybe to do more and get more from China and get more concessions from Mexico. But I think 3 months from now, we're going to be out of the tariff woods, if I had to make a gamble.
I'm glad you said that, because I was going to ask you how long you think that plank is before we begin to fall off into a recessionary mode. But you're saying 3 months, the tariffs might hang around for 3 months. Well,
I mean, like, that's just a punt,
Okay.
But I think, the trick will be is if they put them on, then the waiting game becomes, well, how long? And is this really in for the lasting? And you'll see if they do go on, the markets will just drift down and down and down, and in my view. And at some point, I think the Trump administration would cry uncle and lift them, because it's not their primary motivation.
Got it. All right, we're going to take a quick break so we can line up some phone calls. We're going to be back with Greg Newman. He is the Senior Wealth Advisor and Portfolio Manager of Newman Group at ScotiaMcLeod. He's taking your questions today on North American equities and market protection strategies, which we all need these days. We're back in a moment. Welcome back to Market Call. Thanks for joining us today. Greg Newman is on the show taking your questions. We've already got callers lined up. Faisal is on the line today from Toronto. Faisal, hello. What's your question today for Greg?
Yeah, good afternoon, guys. Morella, welcome to the host chair.
Thank you.
Greg, always look forward to having you on the show. You're one of the most respected and balanced voices across the Canadian investment landscape.
Thank you.
And you're not prone to the hyperbolic comments we see from those folks on CNBC. Greg, I'm calling on TFI.
Yeah.
It is sold off, like really badly sold off.
Yep.
And they've had problems with two of their integration. One they had from UPS, and I can't remember the other one. Is it sold off at this point to start, to build a position on it? I'll hang up and listen. Thank you again. Bye-bye.
This is a great question. And we thought that their earnings were troughing about a year ago. We were wrong on that. They just had a significant miss in their LTL segment, which is 40% of their business. And, P&C was up 2%. Truckload was a slight miss. So the bad news is that Q4 was way worse than feared. I suppose the good news from a Long's point of view, if you believe the tariffs aren't going to happen, which I'm in that camp, we do think that earnings likely have really bottomed here, and that the stock was an overreaction here to the downside. So analysts have brought their targets down somewhat. But it does look really good here now at 11 times 2026 earnings with an 18% earnings per share growth rate 2025 to 2027, which gives it a really nice PAG ratio. It's trading way cheaper than its peers at around 8.3 times versus about 10 times.
Did it take a hit at all from that reversal of its decision to not go to the U.S.?
So you know what? I would say that's a great question. Noise. That part of it is noise. They were going to go to the U.S. and then the shareholders said we don't want that, so they haven't. I don't think that's really part of the story, but this is a good growth stock. You do want to buy it when it's weak. You don't want to buy it if we're going in a recession, and we're gonna unfortunately, go that way if tariffs go on and hard and large, but. That's not the base case.
Okay, so maybe hold off a little bit until we see what happens next Tuesday? Well,
you know what? That's a very good question. I mean, right now, in this intervening period, when we don't know whether the tariffs are going to go on Tuesday, and then they probably won't put them on Tuesday, but then we're still in play till April 2nd or April 4th. So do you want to be buying a growth-seeking name when you're uncertain about the direction of the economy? It really depends upon your view. I mean, I can't see the Trump administration really taking a self-inflicted wound to the head and inheriting a good economy and then taking it into a bad economy. Yeah. So I'm more of a buyer than a seller here.
All right.
Yeah.
Let's move on to Ryan, who's calling us today from Saskatoon. Ryan, what's your question today?
Oh, hi, Greg. I just had a question for you on Cargojet. This stock was around $100 in December. It rallied up to $125 and back down under $100 here. Just wondered if you'd be a buyer of it here or if you see more downside. Thanks a lot.
Great question. We just trimmed our targets, or a lot of analysts did, because of additional CapEx. This has been a very CapEx heavy name over the last couple of years, expanding their fleet with more jets. To the positive, they ended 24 with they crossed the $1 billion in revenue mark, which was EBITDA up 10%, which is nice. We are worried about tariffs with this name if tariffs do go on, but it is, it's always traded a little bit pricey. 11% earnings per share growth is what we expect, and trading at 19.5 times. So, do I like it? I do. Could you probably buy it at a lower price? Yeah, but it's a good grower over time, and it's probably technically at a level now that you could start buying a little bit if you're sanguine about tariffs.
And is there any way, if you're Cargojet, to protect yourself from something like tariffs? I mean, that's your business, right?
That's a great question. I mean, everybody in Canada is trying to figure that out right now. Like, how are we going to diversify,
Pivot.
How are we going to pivot?
Yeah.
Good question.
All right, we'll go back to the phone. Nazar is on the line. He's calling today from Scarborough and has a question. Hi, Nazar.
Oh, hi, Marilla. Hi, Greg. May I have your thoughts on Pembina pipelines, please? Pipeline stocks have retreated lately, and so has Pembina. It had a 52-week high of $61 and is now trading at $52. I heard your opening remarks on tariffs and markets, and it was very enlightening. Is PPL a buy here at 5.3% dividend yield? Thanks for taking my call.
Thanks, Cesar.
It's a great question. I didn't know it was about Pembina, but happy to talk about Pembina and all the pipelines. And look, all their growth estimates have really gone up in the last few months. With natural gas prices having gone higher, and with more throughput looking likely on Trans Mountain, and new projects being built, and it looks like there's more incentive in Canada now to talk about moving more oil east, west, north, south.
What used to be more taboo is now on the table. Yes.
Is now really seriously on the table. So, I like a lot of them, and their growth numbers have all gone up across the board. And so Gibson just sold off on their marketing. That's an opportunity. AltaGas is got better growth numbers. That's an opportunity. I would say Pembina is probably number 4 or 5 on the list in terms of which ones I'd be buying first. But Pembina is a solid company. Its valuation is more attractive than it's been. And I do like it. I don't think you're going to get hurt with any of these. Well, with Pembina, yeah.
Got it. All right, we are going to leave it there for a moment. We have callers still waiting on the line. We'll come back to those. Greg Newman here today, Senior Wealth Advisor and Portfolio Manager, Newman Group, ScotiaMcLeod, taking your questions today on North American equities and market protection strategies. We're back in a moment. Welcome back. Thanks for joining us here on Market Call. We want to go straight to your phone calls. Jerry is on the line today from Edmonton with a question for Greg Newman. Hi, Jerry.
Yes, good morning. Thank you for taking my call. I was wondering, Greg, what do you see the range of oil coming in with the next month or two with this tariffs coming in there? Thank you very much. I'll listen to your answer. Bye now.
So much at play. What a great question. I mean, first of all, Donald wants to have another 3 million barrels coming out of the United States. They already got, I think, 21 million. Adding another 3 million. Look, our company's going to respond after the near-death experiences that they all had from production at all costs years ago. I don't know that they're going to really respond. But also, what else is in play is Russia. Is there going to be a thaw potentially down the road with the West with Russia, and what's ultimately going to happen with Iran? So all these things are affecting. Now, I think it's the IEA believes that global demand is going to be higher. I think 2 to 3% in 26 and 27, and I think it peaks at 29 and 30. Look, I can tell you that the Canadian oil companies are pretty cheap. They're pretty attractive. They're returning a lot of cash. And very shareholder-friendly initiatives, dividends, buybacks. But would I be an investor of oil with all this noise? I wouldn't. It wouldn't be the first place. I would be more in the natural gas side, which I think is an export that needs to happen. Germany came to us a couple of years ago. Italy came to us, and now we're responding. And the Asians, the price in Asia is far higher than it is here, and natural gas is double of what it was maybe a year ago. So I think that's where you want to be.
And even with a 10% tariff, that's still something you would invest in?
Well, first of all, I don't think, that's a great question. That's what he asked about. Okay, so I don't think that tariff's going to go on. And even if it does, 10%, I mean, we're talking with these discounts of Western Canada Select and AECO. They trade at these massive swings. 10% is not that big of a deal. It's not it's not like a 25% across the board. So oil, these companies can survive if there's 10%.
Got it. All right, let's move on to our caller, Al. He's also calling from Edmonton today. Al, what's your question?
Yes, good morning. Could you please tell me your forecast for Air Canada, and would you be a buyer at this time? Thank you.
So that's a great question. I mean, their latest earnings on Q1, they deferred their CapEx, which was a positive, which was earlier than expected. They're very agile. They have a lot of flexibility in their fleet. They got a real strong balance sheet. They're way cheaper than their U.S. peers at around three times. Stock is very cheap on a PE basis, under 6. We do see 25 being a soft year and earnings per share being down 25%. But we do see them growing in next year, in 2026 and 2027.
Why do you see some softness this year?
Softness this year, really due to this tariff uncertainty right now, and load factors and some decisions that they've made. But we do see growth returning in the next couple of years. I think if tariffs don't go on, this is probably a really nice buy. This is not your highest quality name. This is kind of more of an alpha name. This is something that you put in a non-registered account, and it's more of a trading stock. Airlines are almost always trading stocks, not long-term buy and holds. But this is probably at a level that if tariffs don't go on, you can buy it.
Got it. All right, let's move to a question that came in an email. Frederick sent this in. He sent it in from Whitby, Ontario. He says, my question is about CAE. I bought it at 36 5 years ago, part of a balanced portfolio. CAE removed its dividend about 3 years ago, and now it's valued at $27. Should I hold on to it or should I sell it?
So I think this is an old email because I think CAE is now trading towards 36 now. So but they did have a big jump from the fall, from 27 to around 36 on faster than expected defense margin recovery. Okay. They did some solid board appointments, which the market really liked. The company's guided higher since then. And you know what? We are modeling pretty good growth at 22% growth 23 times. So normally I would like it, but I think the stock has had too big of a move. I'm not convinced that they're going to actually hit those growth numbers. One thing I will say is if tariffs do go in, I mean, it's going to affect everybody negatively, but companies like CAE and Exchange Income Fund are less exposed than would be a Bombardier and an Air Canada, for example. So it would be more defensive.
Okay, and you're right. They're up at about 35, 35 today. All right, we have one more question we want to get to just before we go to a break. That's Sal, who's calling from Toronto today. Hi, Sal.
Hi there. Yeah, my question's on WSP Global. It's in the engineering services field, along with Stantec and Atkins Realis. I just reported yesterday the earnings seemed positive, and the stock did take off earlier this morning, but then seemed to be on a downward trend. I was just wondering, given the tariff uncertainty, it seems like it's geographically distributed in terms of its revenues. Is this a good time to add now to WSP Global? Looking forward to hearing. Thank you.
So this was a top pick of ours. I think, when it just came out of Genovar, changed its name, I don't know, maybe 10 years ago, way down maybe in the 20s. Look, they just had really solid earnings just the other day. Their 25 to 27 targets were way higher than what the street was looking for. Greater than 40% revenue growth, greater than 50% EBITDA growth, greater than 60% earnings per share growth, and greater than 70% free cash flow. So there's very little not to like. And E&C, engineering and consulting, is one of the immune sectors here, cross-border, and being situated in 4 different geographies all over the world. So like it for its digital strategy. The only thing is that it is, it's 24 times 2026, and it's growing at 15%. So problem with these E&C companies is they're really high quality, they're really growing, but they never really get cheap, so I don't know if it will. I would really use the chart to try to buy this one, and I don't think you got to be a hero here and try to chase some of the winners. Let it come down a little bit and get it at a lower level.
All right, and if you are interested in more information, we do have an article online, BNN Bloomberg. We spoke to their CEO, or we heard from their global CEO, so that's online if you want some background there. We're going to take a quick break here on Market Call, back with more of your phone calls as well as past picks when we come back. Welcome back. Time now to take a look at past picks from Greg Newman. We're taking a look back just over a year ago. So February 8th, I believe it was, for 2024. Greg, at the time you picked Intel, the big Nvidia rival there. It was trading at the point at 42.50, excuse me, so about a year ago. And now it's dropped to 23.86, so a 44% drop 43% when you look at total returns. And we kind of know what happened there, but expand on that.
Terrible result. I know why we did it at the time, and they were walking a tightrope. They had huge capex. They were building out a foundry in the United States. I thought they'd execute a lot better on that. They were recently anointed by the U.S. government as being, this is where we're going to have chips. I thought they had that going for them at a lower valuation, and analysts' expectations was that they had a really nice earnings per share growth rate, which we still believe from here. This is going to happen. One out of every 20 stocks is going to hit you in the head and really disappoint you. And what defines greatness ultimately is how you handle situations like this. And you didn't want to own a stock like this really in the registered accounts. So you want to have it where you can sell it as a capital loss, buy it back in 30 days if it's still meritorious. So all the reasons why I bought it still hold. Some of the parts, the market thinks it's worth $38. There's been some discussions of it getting taken over. The market, as I say, still believes 74% earnings per share growth from here, 25 to 28. So I'm holding, and our returns over the last 12 months have been fabulous, but this one didn't help.
Yeah,
that's for sure.
It stumbled. Okay, let's go to your next pick, which was Freeport, and again, this is from February 8th of last year. It was at the time $38.12 US. It's now at $38.59, so it crept up here, a return of 1%, 3% total return.
Yeah, this one's certainly not a victory either. I mean, this is a tough set for me this time. But we bought this for the thirst for a green world and copper, EVs, data centers, the electric grid, potential for M&A with the name. Stock had a nice run. We could have taken it off for a nice gain. It's come down on a weaker China. It's come down on a Trump victory, which was, he's a much less green mandate. And then another Q4, they didn't execute as well. Their 3-year guide was a little bit lower and softer sales and higher CapEx. But really, ultimately, copper's a good long-term bet, and this is a good name. And trading around 15 times with 19% growth rate, I still like it. I think the USA really needs to grow their way out of this deficit. I think the 333, that should be your anchor. Trump wants growth. That administration wants growth. That's going to be good for copper.
Okay, let's move on to the last pick from 2024, which is Uber. Uber at the time was 71.61 American. Now it is 76.57, so some growth there, 7% total return and return.
This is, a higher risk name, and at the time they were just going from revenue growth for years to earnings per share growth. They hit all their numbers. Q4 again, just the other, not too long ago, was a modest beat. Total bookings were up 21%. Mobility was up 24%. The delivery accelerated from 17 to 16. Free cash flow at 1.7 billion. Really, if you flesh it out, 21 times 2026 growing at 28%. One of the best, nice techie names out there. They are, the concern here is that Elon Musk is going to have self-driving cars. We're going to argue that they are the aggregator of that whole ecosystem, and with a name that is ubiquitous. It's like Kleenex, right? Yeah. So we think they win, and buy more.
Okay. All right. Good for that one. We are going to take a quick break. We're going to take your phone calls again when we come back with Greg Newman to take those calls. Back in a moment. Welcome back to Market Call. We're going straight to the phone lines. Edward has been holding from Orangeville, Ontario. Hi, Edward.
Hello. Yeah, thanks for taking my call. Bell Canada, you bought it at when it dropped. You bought it at around 44, now it's down another $10. You still own it, but my real question is about the company they bought. Do you know when it's accretive to the bottom line and or when the deal is finally sealed and done? I'll hang up and listen to your comment. Thanks.
So joint venture partnership with Ziply, I believe, is what you're referring to. And look, that's a great question. This stock has had a real fall from grace. Wireless pricing has been hurting. Wireline pricing has been hurting. 4 instead of 3 has been hurting. The CRTC hasn't been helping with, allowing to sell large incumbents to sell refill fiber. Recently, the immigration, which was really a tailwind for them for a long time, has really changed, and that really affects them in mobility. And the cost of capital. These are very capital-intensive businesses that deployed a lot, and then interest rates shot up. They've come down a lot, but they shot up a lot and caught them off guard. So all these things together have put them in a position where, BCE, and then, of course, this U.S. deal. The market has questioned that. I would say there is a script for BCE to right itself. Several different things. Selling assets like the U.S. have, selling towers, for example, leasing them back. That's one way to really surface value. Their dividend is probably too high. The market is really saying that but some of the parts, BCE is compelling down here. Lots of noise, but do I own it? Yeah, if I had big capital gains that I was trying to erase, which we always do in November, we sold it. But we went back, and in registered accounts, we've just held it. And I think you're going to be fine with BCE longer term. Okay, BCE, of course, is the parent company of CTV News and of BNN Bloomberg as well. Just a disclaimer there. All right, let's go back to the phone. Joe is on the line today from Montreal. Hi, Joe.
Hi. I want to ask Greg about TD Bank. It's another company that's been hammered over the last few months. I know their numbers just came out, and I wanted to ask Greg what effect the tariffs will have on the Canadian banking industry and TD Bank especially. Thank you.
Yeah, TD reported today. Wealth management, capital markets did well.
Great question. Yeah, they beat today. The wealth beat, strong capital markets, trading was strong, particularly in the U.S. Of course, they're shrinking their balance sheet to comply with U.S. regulators. That's a great question. The earnings estimates for the banks have all come up a lot in the last few months. And all the Canadian banks are going to go higher if the economy stays good and there's no tariffs. TD will probably participate least in that rally, although they've done some good things, selling Schwab and replacing their board faster than the market anticipated. But it's going to be in the penalty box. It's going to be like a Wells Fargo was 5 years ago relative to the other banks. So all the banks are going to go up if the economy stays good. Let me tell you, if tariffs go on and stay on, you're going to have a lot more. The magic is with banks are the PCLs, the provisions for credit losses. They are going to go up quite a bit as, a second order effect, loan losses, delinquencies, if tariffs go on and stay on. So only buy the banks if you really don't believe tariffs are going to happen.
And are they all padding enough for that circumstance where they could see a loss in credit?
I don't think so. No, not at all, in my opinion. Listen, banks are extremely well capitalized. Look at their capital levels, like around 13 times. They'll be fine. They'll weather. They'll get through. They'll rise again at some point. But I'm just saying, if you don't want to buy something that, if we're going to go into a slowdown for a particular period of time when you can buy it at a cheaper level.
Got it. All right. We will move on right now to a caller, George, calling in or from Toronto. Hi, George. What's your question today?
Yeah, thanks. Calling about Nvidia. Not sure, Greg, if you had a chance to hear the conference call yesterday and look over the results. But what do you think about this stock right now, and is it a good one for the long term?
Well, you asked the question that the whole world is pouring over right now, right? So, of course, they beat yesterday. Their revenue was up 78%. Listen, significant ramp in Blackwell chips. They are arguing that AI solutions are going to be demanding 100 times more computation power than they do now. And they're arguing that the DeepSeek news is actually a positive for them. I think, this stock before the news was reasonably priced on a price to growth basis. That's going to change as analysts up their numbers. I think the reason why the stock is selling off today is Trump saying that he's going to do an extra 10% on China. So but I think the market, before Trump said that, the stock was up. It was mixed yesterday. I own it. I trimmed a lot near the highs. We still own a significant amount. I'm keeping that on this news. And, I think the stock still works from here.
Yeah, it seems like investors are a little bit questioning, I guess, the results. They got it, but they weren't glorious. So the fluctuation is as much as 4 or 5% here.
Yeah, well, it's what makes a market. I mean, some people do believe that maybe you're seeing peak. You're seeing the best margins they're going to have. And, the margins for this year were guided a little lower until the end of the year for various reasons, because these new chips are harder, they're more complicated, they're more costly. So I think the market was concerned about that. And so I don't think it's a slam dunk, but I think it's a reasonable valuation for its growth. And I think the better view is the stock has more to go.
Got it. Okay, let's move on to Greg, calling today from Winnipeg. Hi, Greg.
Hi, thanks for taking my call. I have a question for Greg regarding all the uncertainty over the Trump tariffs. Will he or won't he, and when? And if a consideration would be to use option callers, sell in a upside call to help fund a downside put, as a protection strategy. I was just wondering how far out would he consider going, and what sort of percentage protection would he be considering?
So that's a great question. Thank you for asking it. So look, I don't like the idea of buying put protection. It's really expensive, and then all of a sudden you buy the put protection, and then you find out that Trump, we're going to delay it to, and then it's really worthless, and it expires worthless. And you do that once, you do that twice, you do that 3 times. Eventually you get tired. Unless you're an institution that really specializes in that, that's a tough way to play. I love the idea of selling calls. I always love the idea of selling calls. You can take a stock that has had a big move. Markets, despite the noise, are still dancing near their highs. So, yeah, selling some calls. And when markets erode and names that you find that you like, you sell puts and you get premium both ways. So it's a great strategy. And near these market highs, even though it's off from the top, there's still room to be selling calls here.
Got it. All right, we have to take a quick break here on Market Call. Back with Greg Newman taking your calls when we come back. Welcome back to Market Call. We have Greg Newman in-house today answering your questions on North American equities. Reg is on the line. He's calling us today from Winnipeg. Hi, Reg.
Oh, hi. Thanks for taking my call. Greg, you've been around for a while, so I got a challenging question for you here. So my question is on Manulife Financial. Now, you reward companies that make good earnings. Manulife last week announced $1.6 billion profit increase from the week before, increased their dividend by 10%, announced they were buying back about 53 million of their outstanding share float, biggest footprint of any insurance company in Canada, in Asia. So all fundamentals very, very good for Manulife. Before they announced their earnings, stock was trading at about 44. You look today, it's trading at 44 or thereabouts. Great-West, one of their competitors, announced about 2 weeks ago $1.1 billion prop, the stock spiked $8 a share. It's very, very weird. Like you look at Manulife's trading pattern each day, it's very weird. Case in point, you go to the TMX last half-hour trading every day, you'll find it. The banks and the financials that own about 40% plus of this stock trade the shares amongst themselves. There's something that doesn't make sense from a fundamental basis on why this is flatlined at 44. It should easily be over $50. I'd like your opinion. Thank you.
So what's the scoop with Manulife?
Well, that's a great question. I mean, listen, my friend, you expect markets to make sense at all times. I mean, this is why we have jobs. I mean, markets are very, very tough, and they can be very, very counterintuitive. And yeah, they had a great beat, and this whole sector is sheltered from tariffs to a certain extent. And Asia beat, global wealth beat, free of negative surprises, unlike Sun Life, which, you know, we're a little bit more worried about their U.S. business, and they're kind of trading roles because it's been Manulife that's had the tail risk forever, and all of a sudden they're free. And our analysts are wondering, should this be trading at a premium? And the viewer is not wrong. I mean, the street model's 12.5% earnings per share growth and trades at 9.34 times. I mean, that's cheaper and way more compelling than banks. Why don't more people own it? Well, it's insurance companies, and they're all kind of hinged at around the same price level and you know, same sort of valuation. I think the answer is a lot of it was already in the stock, and that's why. But I would actually take it as a win. You know, the fact that anything's up in the last week when markets have been pretty tough is actually a really, really good sign. So we've been long this name. This has been a top pick for years. We're still long it. I think there's more to go, but it doesn't go in a straight line.
Got it. All right, so hang on to that. Let's go to Michael, who's calling from Montreal. Hi, Michael.
Hi. Is it possible to have Greg's opinion in regards to Cenovus Energy for a long-term hold as well? Can you comment on their downstream operations in regards to the Q4 report that they've announced last week? And as well, if you had to pick, if not Cenovus, would you go with either a Suncor or a CNQ? Thank you very much.
All right, the energy field.
Wow, okay, great questions. Okay, so Q4 missed, and it was on downstream margins, as the viewer pointed out. To the positive, their upstream projects are on schedule and on budget. We do expect free cash flow to inflect meaningfully in 26 as spending drops and production starts to kick in. Okay. So, you know, if there's a name that I do like right now, it's tough. It's tough to buy a sector that is probably facing headwinds, and I think the underlying price of the commodities here could be tough. But if you're going to choose a name within the space, this is one of them that you can really go to. It's way cheaper than its peers. You know, it's 3.9 versus peers at 5.7. Nice production growth, nice cash flow growth, nice shareholder returns of 8%. But, you know, this name will be adversely affected if tariffs do go on. But all in, I'd be a buyer of Cenovus.
Got it. Let's move on to Paul, who's calling from Toronto today. Hi, Paul. Paul, are you there?
Hi, yes, I am.
What's your question, Paul?
Hello?
Hi, what's your question, Paul?
Hi, my question is on Propel Holdings.
Propel Holdings, okay.
Yep. Okay, well.
I think he just wants to know what the deal is with Propel.
Well, Propel, you know, I hate to sound like a broken record, but listen, 90% of their business is in the United States. So people always ask, okay, what happens if these tariffs go on? Is this name immune? No, because there's going to be less business and less growth in the United States. But, as you know, if tariffs don't go on and we have a good economy, and right now that's in doubt because there's a bit of a growth scare going on, This is a great stock. It's really cheap at around 8 times with a 36% growth rate. The stock has come down in the last week or so, and I think that's just market. It's not personal to this stock. There's been no analyst downgrades. There's been no news. So I think if you assume that no tariffs, and this is a high risk. I mean, it does pay a nice dividend, but it is very tethered to the credit cycle.
Okay.
So don't buy it if you think we're going into a bad economy, but I like it.
Okay. That is all the time we have for phone calls today, but stick around. Our guest will share top picks. That's coming up next. Welcome back to Market Call, and thanks for joining us. We have Greg Newman in-house today, sharing some of his top picks for today. First one up is AltaGas, which is ALA on the TSX. Why do you like AltaGas?
So, looking for places to hide out, even though our base case is these tariffs don't go on. If they do, these companies are still looking good, even if they do. Great growth in its utilities and in its midstream. Driven by higher utilization rates and system improvements. We expect growth to accelerate in 26 and 27, with Pipestone coming in and Reef at the end of 26. They announced a 6% dividend increase. Outlook for natural gas looks very strong. Prices have gone up a lot. We'll find out more on their earnings on March 7, I believe. Shake it all out. Always looking for companies that are priced right for their valuation. This is growing at about 11% and trading at around 12 times, and combined with that nice dividend, I think it's very fair.
And the 10% tariff is not something you're really worried about?
Look, I think it's going to impact sentiment across the board, but their business, not so much, no.
Okay, let's move to your second pick, which is Parkland Corp, which I think is interesting because of the whole situation with Simpson Oil, where they're trying to pressure them to make some moves, and there seems to be some friction there.
Right, and that's really one of the theses, is that such a word? Look, this should work regardless of tariffs. Don't forget, there was a buy. They tried to buy this company out at $45. It's trading at $36 right now. SOL won their litigation, Simpson Oil. Going to be proposing a new board. They're going to probably push to maybe sell the company or do really other value surfacing ideas. So, I think that there's a few dollars to be earned here of low-hanging fruit just on, corporate reorg and or enhancements or M&A. But even just as a going concern, the market does see their earnings per share growing from a depressed level, but 50% over the next 2 years for a valuation that's 9 times. So if you're kind of looking for idiosyncratic names that are just really not tethered to the news headlines, that's going to pay you something nicely to wait, I think this is a fair name.
Got it. Okay, let's move to your last pick for today, and that is Brookfield Infrastructure Partners. What's going on there?
Well, they just beat by 5%. They got strong momentum in midstream, utilities, data and transport, raised distribution by 6%, inflation-linked revenues, which is important, especially with inflation in the U.S. We just got the PCE today, which is another reason why maybe the markets have been struggling, which is not great. One of the Fed's indicators, we're going to get fresh data tomorrow, but large organic pipeline, robust deal making. Company's very bullish about their data growth, which could provide upside to our estimates that are not in here. But on our estimates, we think it grows 11%, trading at 10 times. So very fairly priced for a nice little compounder that's going to grow 6%, their dividend yearly.
Okay, so same question I have to pose for this one again. We could see the tariffs of 10%, and we don't know where Donald Trump's going in the future. Same thing, that you feel that's not a big threat to the company?
Well, not really. They're very well situated, and they got good U.S. assets and good global assets. So they're still, these guys, the Brookfield people, they're innovative, and they'll make hay out of it. But I think tariffs, if we get tariffs, when I say tariffs, I mean lasting, pervasive, endgame tariffs, everything's going down.
Yeah.
Like, try to find me a name that won't. Yeah, you might find one or two here or there. So sentiment's going to come down. So it would be affected by that. But the business operations otherwise are very strong long term.
And you think if tariffs last, 2-3 months, which is what you were sort of guesstimating on your own, that won't really be a huge problem. You're thinking if they're baked in sort of six to.
Let me clarify. When I said 2 or 3 months, and that is just a pun, I think 2 or 3 months before Donald moves on to something else.
Got it.
I don't think the tariffs will go on for 2 or 3 months. I think they could go on for 2 or 3 days, 2 or 3 weeks.
Got it. Good to know. All right, Greg Newman, thanks for coming in. Really appreciate you coming in today, and thanks for your time.
Thank you.
That's all the time we have for the show on Market Call. Thanks for joining us today, and I'll see you again tomorrow.